And welcome back. You're on the money with me, Liam Halligan. Now, as we all know, interest rates are on the rise, with the Bank of England having increased their base rate another 0.5 percentage point in early August to 1.75%. That's still pretty low by historic terms, but it's the highest since the financial crisis in 2008. And it clearly means households will now pay more in debt interest, not just on their mortgages, but other loans. They could be paying billions more, according to new research from YouGov. Well, joining me now is seasoned journalist and independent mortgage specialist Paula John. And, of course, MissMoneyMagpie.com, Jasmine Birtles is still with us. Paula, a pleasure to see you in the studio. You and I have been talking about mortgages over many, many years, going all the way back to my days on Channel 4 News. Great you're still in this business. What does this YouGov research show us? Because a lot of people are really worried about their debt service costs going forward.
They really are. What it's highlighting is that even though a lot of people's mortgages are on a fixed rate, a lot of their unsecured debt is not on a fixed rate.
So that's credit cards.
Credit cards, store cards, personal loans, car loans, all of that stuff.
Yeah.
So credit cards, I'm sure you know the average credit card interest rate hit 22% last month. It's the highest rate for 25 years. And basically the cost of all of it is going up. So over 1 million people have already seen their credit card bills go up more than £60 a month, which is a pretty chunky increase. Now, obviously, that doesn't apply if you pay off your credit card in full every month, because the interest rate is irrelevant because you're not paying the interest.
That's right.
But more than 50% of people don't do that, and 15% only pay the minimum. So it's storing up trouble for them. And on the personal loans front, almost 8 million people have got a personal loan on top of the mortgage of an average of £6,000, and they've already seen that increase by £900 a year. So these non-mortgage costs, these other debts, are really starting to bite at the same time as all of the rest of the cost of living crisis.
Incredible, the scale of that average non-mortgage unsecured loan that most households have. And, of course, as the cost of living squeeze bites, a lot of people with the best will in the world, they want to do the best by their family. They want to keep the basics coming in and the odd treat every now and then. They do go into more debt, don't they?
They absolutely do, and we can only imagine that people's personal balance sheets are going to be deteriorating further with all of the different pressures on them. So, I mean, what can you do about it? There isn't a silver bullet. Unfortunately, there is no way of saying, oh, there's a 1% interest rate something over here. But it does feel like it's a good time for people who've got these kind of debts, which most people have, to take a careful look at them. Try and get your ducks in a row before interest rates go up, because as we've been discussing for weeks now, the bank base rate could hit 4% next year. I mean, it's frightening, and that will have a knock-on effect on all of these sorts of debts. So it's a good time to be looking at where your debts are and seeing what you can do about that. And one thing that more people are starting to do now is to consolidate their debts.